Interest rates are one of the most powerful forces in our economy, yet they often feel mysterious. Let's start with a simple definition. An interest rate is the cost of borrowing money. Think of it as a rental fee for cash. When you take out a loan, you pay back the amount you borrowed plus an extra percentage. That extra percentage is the interest. On the flip side, when you put money into a savings account, the bank pays you interest. In that case, you are the one lending your money. These rates are not set randomly. They are a tool used by central banks like the Federal Reserve in the United States to manage the economy. Why should you care about these numbers? Because they affect almost every major financial decision you make. They influence the monthly payment on a mortgage for a new home. They determine the cost of a car loan. They change how much you have to pay on your credit card balance. Interest rates also shape the returns you get on your savings and investments. When rates are low, borrowing is cheap, which can encourage spending and business expansion. When rates are high, borrowing becomes expensive, which tends to slow the economy down to control rising prices. For businesses, these rates determine whether it makes sense to invest in a new factory or hire more workers. For the government, interest rates affect the cost of its own debt. Higher rates mean taxpayers end up paying more to finance government spending. In essence, interest rates act as the economy's accelerator and brake pedal. The central bank carefully adjusts them, hoping to keep the economy growing at a steady pace without overheating or stalling. Understanding this fundamental concept is the first step toward answering our big question. The dream of returning to the ultra-low rates we saw just a few years ago is on many people's minds. But that era came to an end for specific reasons. To figure out if we are heading back there, we must first understand why we left. Not too long ago, the world of interest rates was remarkably calm and low. For much of the decade after 2008, central banks kept policy rates near zero. This was a deliberate strategy. The global economy was weak, and the goal was to make money as cheap as possible to encourage borrowing and spending. That era, often called easy money, had a profound effect. A 30-year fixed mortgage could be secured for around 3% or even less. Savers, on the other hand, saw very little return on deposits. Low rates became the norm. Cheap credit expected. Businesses and consumers factored low borrowing costs into long-term plans. The housing market was supercharged by these conditions. Many people could afford homes that would have been out of reach otherwise. The era felt stable, almost permanent to many. The idea of rates rising significantly seemed distant and unlikely to affect everyday life. In early 2020, the COVID-19 pandemic brought the global economy to a screeching halt. In response to widespread lockdowns and the fear of a deep recession, central banks acted swiftly and decisively. The Federal Reserve slashed its key interest rate back down to near zero. It also launched massive bond buying programs, a policy known as quantitative easing. The goal was simple and urgent: to pump huge amounts of money into the financial system to prevent a complete collapse. This was a whatever-it-takes moment, and the immediate effect was to push borrowing costs even lower. For a brief period, it seemed like the era of cheap money was not only continuing but intensifying. Mortgage rates dipped to historic lows, with some borrowers locking in rates below 3%. Governments also stepped in with enormous fiscal stimulus packages, sending direct payments to households and providing aid to businesses. This combination of rock-bottom interest rates and massive government spending was designed to build a bridge across the economic chasm created by the pandemic. It was a powerful injection of support that successfully staved off a prolonged depression. But this solution planted the seeds of a new problem. The economic recovery, when it came, was unlike any other. Fueled by stimulus checks and pent-up demand, consumer spending roared back to life. However, the supply side of the economy could not keep up. Global supply chains were in chaos, factories were shut down or operating at reduced capacity. Suddenly, there was too much money chasing too few goods. This is the classic recipe for inflation. At first, many policymakers, including those at the Fed, believed this inflation would be transitory, a temporary blip caused by the unique circumstances of the reopening. This belief proved to be wrong. The price pressures were not temporary, they were broad and persistent. The mismatch between supercharged demand and crippled supply led to the most significant surge in inflation in 40 years. The very tools that had been used to save the economy from a pandemic-induced collapse were now fueling an inflationary fire. By late 2021 and early 2022, It was clear that high inflation was not going away on its own. The word transitory was quietly retired from the vocabulary of central bankers. The Federal Reserve and its counterparts around the world had to make a dramatic pivot. Their primary mandate is to maintain price stability, and with inflation running far above their 2% target, they had no choice but to act forcefully. This meant using their main tool, raising interest rates, and they did so with historic speed and aggression. The era of easy money was officially over, and a new era of monetary tightening had begun. The Fed began a series of sharp interest rate hikes, starting in March 2022. It raised rates at the fastest pace since the 1980s. The goal was to make borrowing more expensive, which would cool down demand across the economy. Higher rates would discourage consumers from taking on new loans for cars and home renovations. They would make it costlier for businesses to invest and expand. The logic is straightforward. If you make money more expensive, people and companies will spend less of it. This reduction in overall demand is intended to give the supply side of the economy a chance to catch up, thus easing the pressure on prices. This aggressive action had immediate and widespread effects. The cost of a mortgage, which had been below 3% just a year earlier, soared to over 7%. The housing market, which had been red hot, quickly cooled. Sales activity slowed dramatically as potential buyers were priced out by the combination of high home prices and high mortgage rates. The stock market also stumbled as higher rates made safer investments like government bonds more attractive. The entire financial landscape was repriced for a world with higher interest rates. It was a painful but necessary medicine to combat the disease of inflation. As of today, September 6, 2025, we are living in the aftermath of that campaign. The Federal Reserve has successfully brought inflation down from its peak, but it has not yet returned to the 2% target. The central bank has held its key rate at a high level for some time now, waiting for more conclusive evidence that the inflation battle is truly won. This is the crucial context for our question. The high rates we have today are a direct consequence of the fight against the post-pandemic inflation surge. For anyone who started paying attention to finances in the last 15 years, today's interest rates can feel shockingly high. A mortgage rate of 6% or 7% seems astronomical compared to the 3% rates that were common just a few years ago. However, it's essential to look at the bigger picture. From a longer historical perspective, the rates we have today are not unusually high. In fact, the period from roughly 2009 to 2021 was the anomaly. That decade of near-zero interest rates was the exception, not the rule, in modern economic history. If we look back to the 1990s, a decade of strong economic growth and relatively stable prices, the average 30-year mortgage rate was typically between 7% and 9%. It was a period when the economy functioned quite well with what we would now consider high borrowing costs. Go back even further to the early 1980s when the Federal Reserve was fighting a much worse bout of inflation, and the numbers are truly staggering. At that time, mortgage rates peaked at over 18%. In that context, a 7% rate seems quite manageable. When it comes to predicting the future path of interest rates, there really is no crystal ball. Economists themselves are, well, pretty divided. Still, we can identify a general consensus that's forming based on current data and long-term trends. The majority of experts do not expect a return to the ultra-low 3% mortgage rates anytime soon. While they do anticipate that central banks will begin to cut rates from their current peaks, the landing point is expected to be significantly higher than where we were before the pandemic. The idea of a higher for longer interest rate environment has gained significant traction. One major group of economists argues that structural changes in the global economy will keep rates elevated. Deglobalization. Countries focus more on resilient domestic supply chains rather than just the cheapest global option. This process is inherently inflationary. Furthermore, the massive investment required for the green energy transition will increase demand for capital, pushing up the cost of borrowing. Demographics also play a role. As baby boomers retire and spend their savings, it could reduce the global pool of savings, making capital scarcer and more expensive. On the other side of the debate, a smaller camp of economists believes that the long-term forces that kept rates low for a decade have not really gone away. They argue that aging populations in advanced economies will still lead to higher savings rates overall, and that technological innovation, especially in artificial intelligence, will be deflationary by boosting productivity. In this view, the recent inflationary spike was more of a one-off event caused by the pandemic and a massive fiscal response. Once these effects fully fade, they contend, we will return to an environment of low growth and low inflation, which would naturally lead to lower interest rates. Data from financial markets provides a real-time gauge of these expectations. The pricing of long-term bonds and derivatives suggests that investors are betting on rates coming down from their current highs, but settling in a range well above pre-pandemic levels. For example, market pricing might imply a long-run Federal Reserve policy rate of around 3 to 3.5%, which would likely translate to mortgage rates in the 4.5 to 5.5% range. While this is better than 7%, it is a far cry from the sub-3% world of 2021. To truly understand where rates might be headed, we need to look at the underlying economic drivers. One of the most important concepts is the neutral rate of interest, often called R-star, or R. This is the theoretical interest rate at which the economy is in perfect balance, not booming and not in recession, with inflation stable at the central bank's target. If the policy rate is below the neutral rate, it stimulates the economy. If it's above, it restricts the economy. A key part of the current debate is whether this neutral rate itself has risen. For years, economists believed the neutral rate was falling due to an aging population saving more for retirement. However, the post-pandemic landscape might have changed this. Increased government spending and debt, large-scale investment in new technologies and green energy, a more resilient but less efficient global supply chain, could all be pushing the neutral rate higher. If the neutral rate is now higher, the new normal for interest rates will also be higher. Inflation expectations are another critical driver. If people and businesses expect prices to rise quickly, they will act accordingly. The abstract world of economic policy has very real consequences for your personal finances. The most direct impact of rising interest rates has been on the housing market. For a potential home buyer, the difference is enormous. On a $400,000 loan, 30-year mortgage at 3% equals $1,686 per month. 30-year mortgage at 7% equals $2,661 per month, nearly a $1,000 difference every month, pushed homeownership out of reach for many, significant slowdown in home sales. The impact extends to all forms of debt. Auto loan rates have climbed, more expensive to buy a new car, more expensive to buy a used car. Credit card APRs are typically variable and tied to the Fed's policy rate. As the Fed hiked rates, interest on card balances has soared. Variable rate borrowers have felt a direct hit to their monthly budgets. That's the intended effect of monetary policy. Make borrowing less attractive, encourage saving more, encourage spending less. However, there's another side to the coin. For savers, higher interest rates are good news. After a decade of near-zero returns, people can now get significant yields from certificates of deposit, high-yield savings accounts, money market funds. Savers once pushed into stocks can now earn safe yield on cash. Welcome news for retirees and anyone relying on interest income. It rebalances a landscape long tilted toward borrowers. Ultimately, interest rates shape behavior. Low rates lead to risk-taking, borrowing, spending. High rates lead to saving, deleveraging, caution. The shift from low rate to high rate has been a shock for households and for businesses. Adjusting to a reality where borrowing has real costs and saving has real rewards is the central financial challenge today. Whether this new reality is permanent is the billion-dollar question. So, let's get to the bottom line. Based on the evidence and expert consensus as of late 2025, a return to 3% mortgage rates like 2020-2021 is highly unlikely soon. While not impossible far out, current economic forces point to a new normal of structurally higher rates than the post-2008 decade. The unique combination of global pandemic, massive government stimulus, snarled supply chains has reset the economic landscape. The primary reason, the ongoing battle against inflation. Inflation has cooled, but central banks will stay cautious. They can't cut too aggressively and risk inflation flaring up again. That would damage credibility and force higher hikes later. So, rate cuts will be slow and deliberate, only when price stability is certain. That makes a rapid plunge back to ultra-low rates very improbable. Beyond inflation, structural shifts suggest a higher baseline for rates. Move away from globalization, huge capital needs for the green energy transition, higher government debt levels. Many economists now think the neutral interest rate is higher than before the pandemic, meaning the long-run baseline will be above the near-zero levels we got used to. Final answer: clear, but disappointing for hopeful borrowers. The 3% mortgage was a product of a very specific, unusual period, a golden era for borrowing that's now behind us. More realistic, mortgage rates settling around 4.5% to 6%. Still better than recent peaks, but a decisive end to ultra-cheap money. Adapting to this new reality, more expensive borrowing, more rewarding saving, is the key task for households and the economy. Remember, from a historical perspective, these rates aren't extreme. The 1990s economy thrived with mortgage rates between 7% and 9%. Markets and consumers will adapt, new financial products will emerge, different strategies will develop for this environment, and let's not forget, millions of savers and retirees are finally earning meaningful returns on their money for the first time in over a decade. This rebalancing toward rewarding saving and making borrowing more thoughtful may actually create a healthier, more sustainable economy in the long run. So while the dream of 3% mortgages may be over, the new normal doesn't have to be a nightmare. It's simply a different economic landscape, one that requires new strategies but still offers opportunities for those who understand it. The era of ultra-low interest rates was extraordinary, but it was also extraordinary for a reason. As we move forward, understanding these new realities will be key to making smart financial decisions in a world where money once again has a price.